I think we can all agree that the last couple of years here in Ottawa, from the real estate side, the market has been absolutely insane. From rising home prices to non-stop bidding wars, navigating all of this is a major challenge. But there's been two factors that a lot of people are now talking about, and I think it's time we mention inflation and rising interest rates and what this all means for you. We'll take a look at some current rates and the history of rates and help you make sense of all of this. Stay tuned. All right, let's start with inflation. Inflation happens when prices for goods and services rise and purchasing power falls. When inflation goes up, people and businesses have to spend more money to buy the exact same amount of goods and services. Simply put, everything becomes more expensive for the exact same thing. But how is inflation calculated? There's something called the Consumer Price Index, or CPI, and it looks at what the average consumer spends and checks back every month and every year to see if there are any differences on how the money is being spent and by how much. This is known as inflation, the rise or change of prices over a given period of time. Here we have the Consumer Price Index, January 2022, and basically it's saying that the Canadian inflation has surpassed 5% for the first time since September of 91, rising 5.1% on a year-over-year basis and up from a 4.8% gain. Now, what I wanted to point out was right here highlighted in blue, COVID-19 pandemic-related challenges continue to weigh on supply chains and consumer energy prices remain elevated, and this, of course, being the main reason why we are seeing inflation, especially the last 2 years during the pandemic. So now the big question becomes, what causes inflation? Well, we've seen it in the last 2 years, especially during the pandemic. Prices rose when demand outpaced supply. Labor shortages, logistical problems, all created more problems and thus the prices went up. Some businesses can absorb those costs, but some can't. And the ones that can't responded by increasing prices to offset their expenses, or else they'd be out of business. So now the consumer has to step back and think about the following. If my salary hasn't increased, how's it going to combat these rising prices? Is it the same as I'm getting paid less? Do I have to stop buying things that I did before? Or the more important question, can I still afford to buy a home? And then you have interest rates, historic low interest rates that we've never seen before. That means people have access to more money, right? Lower interest rates means people and businesses have more money in their pocket or can borrow at a really cheap rate, and that means they're likely going to spend. They'll take advantage of this and buy homes or refinance their homes and pull out equity. And guess what you can do with all that equity? Spend more money. Here are today's rates from the top 5 big banks. Okay, here we got the best big bank rates in Canada as of April 3rd, 2022. We have 5-year variable versus a 5-year fixed, even a 3-year fixed for the consumers that are interested in a shorter term. Let's take a look at the top 5 banks and what they're offering. So Bank of Montreal right now is offering a variable rate at 2.15% versus a 3.69 for fixed. Now, this is the most common question consumers have. Obviously, the variable rates, they fluctuate versus a fixed term. It stays constant for the period of time that you're looking to lock it in for. TD Bank, 2% variable versus 3.69 fixed. CIBC, we got 1.99 versus 3.72. RBC, 2.2% versus 3.94 for fixed. And of course, Scotiabank, 2.25 versus 3.99. So this is just to give you an idea of the difference of the rates and what the banks are offering. You can get more information at ratehub.ca or reach out to your mortgage broker or lender to get more information. How does this all get tied up in real estate? Well, it's pretty simple actually. When you're making a move, you need to consider different factors in the current environment you're in. You need to make a plan, and that includes the price you're going to pay for a home or the amount you're qualified at and the mortgage that will come with that, and it includes the interest rate. If your purchasing power is affected and the interest rates get more expensive, can you still afford this? Here we have a 5-year mortgage rate history. Goes all the way back to 1973 to 2010 and beyond. And as you can see, we're kind of hovering 4.79, 5.34, back in 2015, 4.64, 5.24. Now, if you just, gives you an idea of kind of where we've been with rates the last little while. As you can see, there's been some pretty high rates in the past.
Again, check out ratehub.ca and navigate over to the right-hand side, and you can even look at a 10-year fixed mortgage rate. Let's check out the 5-year variable mortgage rate history, what the difference is there right now. So in 2022, we are about 1.15. As you can see how low got all the way down last year to 0.98. Now, here's the interesting part is back in 2020, we're about 1.84, 2.65. 2019, we're about 2.61, 2.70, and then if you want to go all the way back to like 2008, up in 4.95, and then just before that, 5.65. Again, just to give you an idea, variable versus fixed, and the history for it.
Do you still have options, or are you forced to step back? Despite changes in the market, the mortgage brokers or lenders examine the big picture and help you determine if it's the right time to buy or should you wait. Each client's case is different, and that includes their financial profile, risk tolerance, future capacity, and really understanding the goals and objectives for you and what you're looking to do. So what about Ottawa, and what can we expect from all of this, or how will this get solved if you're a buyer? Interest rates are going up, and we know that, and it will affect your monthly payment. This will probably take away a little bit of that demand, but for the consumers that absolutely need to move, they'll make it happen. I think that supply will start to tick back up, and builders will start developing more as the city approves all the backed-up applications. Don't forget all the sellers that stepped back to list their home when the pandemic started 2 years ago, and they had every reason not to allow strangers to come through their home. And of course, that limited our supply by as much as 50%, so buyers had even less to choose from, which created all this aggressive competition. So I'm hoping as the new construction side picks up, resale picks up, and demand maybe slows down a bit. Now, will this happen all this year? Probably not. Don't forget, we've been in a seller's market for over 25 years, and we're a growing population with government sustainable jobs, and the out-of-towners that are moving here making this a very attractive and secure market. But if you are in the market today, I would say you need to consider the 4 following things. Number 1, interest rates the last 25 years and where we are today. We've seen this before, and we were able to manage it. The rates did fall down to below 2%. On average, rates were much higher historically. Does today's interest rate make sense for you? Definitely speak to your lender or get a second opinion. Number 2, inflation. Can we come back down to the average? Again, I think this will depend on the pandemic-related challenges and supply issues. We're only just now starting to come out of restrictions, and will need more time to recover. Number 3, appreciation in home values. In 2020, the total home appreciation was 19.9%, and in 2021, it was 22%. Right now, we are beating the predictions that were set for 2022, but still have 3/4 of the year left. But regardless, it will be a positive increase in home value year over year. Number 4, months of inventory, or how much current supply there is. Right now, we're below 1 month. We need much more inventory to balance out the demand. And yes, that means building more homes, and yes, that will take time. Overall, as a consumer, you need to consider that the qualifying rate or stress test, currently set at 5.25%, is much higher than the current rates and inflation happening in Ontario and Ottawa specifically. Lenders qualify you much higher on purpose to make sure there is room should rates or inflation increase. Remember, they're the ones lending you money for a mortgage and are just being careful. Those are their rules. Supply and demand is the backbone of real estate, and we're in a strong seller's market, despite rates and inflation. Again, we've seen these rates in the past, and we're still below the average. And most importantly, home prices will outpace inflation. We see tons of improvements in housing in terms of how people in the market prefer new homes, or if improvements are made to older ones. This adds value and is what the consumer is looking for. What are your thoughts on rising rates and inflation? Is this the new norm? Is it manageable? Will future government programs help with the issue of supply? Would love to hear your thoughts and comments below. Thanks for tuning in, and catch you in the next one. Peace.